Guys, 119,000 jobs were added, but unemployment just went up to 4.4%. Now, at the same time, job layoffs hit a 20-year high in October, and we're missing an entire month of jobs data. Now, I'm telling you right now, people are not ready for what's coming. Stay locked in because in this video, I'm going to tell you what's about to happen and exactly how to get ready for what's coming. Now, the September jobs report was slated to come out October 3rd, but it just came out a couple of days ago due to the 43-day government shutdown that we all know about, right? And the numbers looked okay on the surface, right? 119,000 new non-farm jobs added in September, great. And unemployment at 4.4% doesn't seem horrible, right? Even though that's the highest in almost 4 years. And the August jobs report, by the way, was just revised down to a job loss. Now that's big, but here's the biggest problem. We don't have the October jobs report. It was canceled and it won't be available until it gets merged with the November jobs report. So we're looking at pretty old data that's incomplete, right? And we're looking at this during one of the most fragile moments in our economy. Now, meanwhile, you have companies that are not simply waiting around on the jobs reports, right? These companies are reacting right now because companies are always forward looking. They're making moves today to prepare for what they see coming down the road. So right now you have major companies that are laying off tens of thousands of people and cutting jobs if you've been listening to the news lately. This is part of a headline story that they sometimes put on the back page, right? But you need to hear it. There have been some big layoffs in the last 60 days. You have UPS. They said 48,000 layoffs. Yes, 48,000. Then you have Amazon. I think they mentioned 14,000 corporate job cuts. Then you have Verizon having a major round of reductions that was in the news last week. Then, of course, there's Meta, there's Google, there's IBM. All of them are laying off people due to the ongoing boosting of AI. Then, of course, there's manufacturing companies laying folks off, right? You got tech, you got retail. Listen, this is real job loss, right? Affecting real people and tens of thousands of real families. And now let's talk about exactly what happened in the month of October, because this is huge. The month of October gave us a massive warning that you may or may not have heard about. October 2025 saw more than 153,000 job cuts that were announced. That was the highest October total in more than 20 years. 39,000 plus people were notified of layoffs in 21 states. That's one of the highest amount of people who were notified of layoffs since 2006, okay? And it wasn't just one sector, right? It was tech, it was transportation. Like I said earlier, it was telecom, retail, finance, real estate, you name it. A lot of places are laying off everywhere. And here's the thing that I want you to remember, okay? We don't have an official jobs report for October. So that means October, with the largest layoffs in several decades, is the same month where the government couldn't collect the household surveys. And so we have no official jobs report for that month. Let that sink in. So you got to ask yourself, is that by accident or what? Now, I'm just saying, I don't want to spark any conspiracy theories, but it's something to think about. So now the question is, why is this happening right now? Let's break down some of the causes, okay? First, you have one of the obvious things that have been taking place, which is AI replacing white collar and blue collar jobs left and right, especially the mundane, real basic types of jobs, right? So you have companies from Amazon to some of the big time telecom giants who are replacing customer service, logistics, analytics, and admin staff, the stuff that a computer or a robot or AI could handle. And then across many companies and corporations, you got basic cost-cutting measures taking place more often now, right? Margins are getting tighter and tighter. Interest rates are higher now than they had been, right? And so borrowing is more expensive and more tightly regulated nowadays than it had been. And again, companies are preparing for a slowdown. So what is usually the highest expense for most businesses? It's payroll. And if we can replace your $50,000 a year job with AI that may cost us $10,000 or $5,000, companies are going to do it. Then, of course, you have that 43-day government shutdown where the federal agencies froze hiring and delayed projects and downsized, right? And of course, you got major instability among the 3 or 4 million Americans who work for the federal government, right? All of this is making consumers pause and stop and slow down their spending, which ultimately affects what? Companies' profits. And when companies' profits are affected, the first thing they're going to do is lay off people. And this is where Donald Trump comes into the picture, right? You have President Trump publicly pressuring the Federal Reserve to cut the Fed funds rates quickly. Now, Trump has said many times that he expects much lower interest rates under the administration, especially once he appoints a new Fed chair. And a new Fed chair will be coming into the mix here in about 5 or 6 months. That could change a lot of stuff in terms of the federal funds rate and the overall monetary policy. So stay tuned for that coming up at the beginning of 2026. But here's the truth. Political pressure on the Federal Reserve always equals uncertainty, especially for businesses and the stock market. When the Fed feels political heat, the Fed usually hesitates because they don't want to be seen in a political light, even though the Fed moves that they make oftentimes looks pretty political, right? The Fed also tends to sort of split internally when they feel political pressure because the president appoints the Fed chair and appoints the Fed vice chairs of the Federal Reserve Board, right? Which is then confirmed by the Senate. So although the Fed tries to stay neutral, there's some political pressure that comes just by virtue of how the Fed chair is selected by a president. And then the 43-day government shutdown we had didn't really help matters much for the Fed. The Fed was having to basically steer monetary policy with missing data, more layoffs, and of course the political pressure, right? So all of that makes for a sort of a dangerous combination in my opinion. But here's why all this matters for your wallet. Now, this is the important part, because what's happening right now, guys, it affects your job security. Companies are preparing for slower growth. That means potential layoffs. It also affects, let's say you're a rental property owner. You own rental property. If tenants lose their jobs, you lose cash flow, right? And the whole interest rate argument is this: if the Fed delays cuts in the federal funds rate, it means borrowing stays more expensive longer, which could affect us as consumers. And of course, again, your investments, right? Markets, the stock market hates uncertainty, right? Stock market goes down under uncertainty and under job loss and under political pressure. The stock market doesn't like all that. And then, of course, your income streams. Look, if you have a side hustle, you may have a drop in customers when people tighten their budgets. So this is not a moment to be casual or comfortable. This is really a warning, my warning to you, because most people, they think, oh, the economy added 119,000 jobs. Everything is going great. No, not really. The layoffs tell the real story. Now, listen, the Fed is going to have their next meeting coming up. It's important you know that the Fed is going to meet, December 9th. And now the stock market is expecting a rate cut or the Fed to lower the Fed funds rate. Now, that means the stock market expects the Fed to make money cheaper to borrow for short-term loans like car loans and credit card interest rates. Cheaper money around Christmas time is always seen as a plus for many retailers, right? But a rate cut is not guaranteed, especially with this missing job data, right? Because the Fed is split, right? Some, like the New York Fed President John Williams, expects rate cuts. And then you have other Fed chairs for other districts who are wanting to wait on a rate cut, right? So there's some split right now in the Fed, in the FOMC, the Federal Open Market Committee, who is the committee that makes the decision on what to do with Fed rates. So the October layoff picture, because they really look at job data, those October layoffs sort of complicate the picture for the Fed in terms of what they're going to do next. And when you throw in the mix of President Trump adding pressure, it makes for an interesting possibility, okay? So here's the deal. If the Fed cuts rates, Fed funds rate, too early, that's an inflation risk, because cheaper money causes people to do what? Spend more. And when people spend more, demand goes up for goods and services. And what happens when demand goes up? Typically, prices go up and inflation rises. So the stock market loves when the Fed cuts rates because the stock market is businesses, and businesses want to increase demand. And all of that spending is good for business. So a rate cut stock market typically goes up. If the Fed doesn't cut rates coming up here on December 9th, then the stock market could face a panic because these businesses, they don't see an increase in spending on the horizon. And that means these businesses are going to tighten down more and stocks will go down, right? See the correlation there. So when the Fed does not cut rates, businesses prepare for slower times. And what do they do in those slower times? They cut jobs. Now, this would be when we see the unemployment rate potentially continue to go up if the Fed decides to hold off on cutting rates. So what the Fed decides to do with the Fed funds rate could trigger the next big economic shift that we got to pay attention to. Now, this is why the warning light is on, and the Fed's decision matters and affects jobs and the stock market. Now, what should you do now to prepare? Here's some things you can do today, right? Number one, stress test your income. Assume a potential job loss. In other words, ask yourself this question. What happens if one income stream of mine drops by 20 or 30%? What if I own rental property, for example, and a tenant misses 3 or 4 straight months of paying their rent? What do I do? Or maybe you can ask yourself this really simple question to help you prepare. What if I lose my job and I don't have income for 4 or 5 or 6 months, right? When you start thinking in terms like that, it makes you want to prepare more. And I'm saying that's what you should be doing. If that answer scares you, you need to make some adjustments today, right now. Now, another thing you can do is sort of reposition your investment portfolio. In other words, shift your portfolio, your investments gradually toward cash flow assets, perhaps, like maybe real estate. It's just a thought. Or maybe you shift your portfolio, your investment portfolio, over to defensive sectors like stocks and ETFs and index funds that are considered stable, right? And less vulnerable to some of these economic downturns that we may be facing, because defensive sector stocks and ETFs and index funds, they provide essential goods and services, no matter what's going on in the economy, like the utility sector or consumer staples or healthcare. So that means adding some lower volatility stocks and index funds and ETFs to your portfolio. And here's another one. Maybe you add some hard assets, like I said before, real estate, maybe some precious metals, maybe some collectibles, maybe some machinery or equipment. Listen, I'm just giving you the whole gamut because all of that is things that you should be considering and should be on the table right now. These hard assets, they're not tied to paper assets like stocks and bonds and index funds, right? And maybe you need to spend some time softening your position in something like tech. Instead of having 60 or 70% of your stock portfolio in tech, maybe you balance that out a little bit, reallocate. Don't have everything wrapped up in crypto that may drop like it recently dropped. That volatility ain't really fun in this type of economic climate. And for my real estate owners, if you actually own rental real estate right now, you need to be preparing for much slower rent growth than you've experienced the last several years. Those days are coming to an end. And for a lot of people who don't own rental property, that's a great thing, right? Because rents have been out of control for the last several years. So if you happen to own rental real estate, just be prepared for more tenant turnover, more late payments, more, lower rent raises. Those things are going to happen. That's the reality for people that actually own property. Now, another thing to think about is your cash positions, your liquidity, right? We all need to make sure we have more cash reserves in times like this when you see a rising unemployment rate. Right? So we lower our spending, and the dreaded cut your household expenses, that's coming, because that's always something you should be thinking about doing if possible, right? And then save more money and avoid any big purchases that rely on your future income, right? Like don't go into debt on anything that's going down in value. Get out of any bad debt. And bad debt is just debt on something that is not increasing in value. You want to get out of that bad debt as soon as possible, because that debt leaves you powerless and with fewer decisions, fewer choices. And then stop assuming, guys, that the interest rates, the cheaper money is coming back anytime soon. And that means we need to stop assuming that the Fed is going to drop these Fed funds rates really fast and return to the 1% and 2% Fed funds rate like we had 6 or 7 years ago. That may not happen for the next 20 or 30 years. The Fed might not cut rates or the Fed might hold right where they're at for the next year or two. The worst mistake that you can make right now with your money is building your life around the hope that interest rates are going to fall quickly. You got to plan for many scenarios with your personal finances. Now, I see the opposite of good news happening right now, to be honest with you guys. Most people see 119,000 jobs being added. Good. But I see record October layoffs. I see mass job cuts at large companies. That's always telling because that gives an indication of what they're looking at down the road. I also see missing government data. I see a split Fed right now in terms of what they're going to do with the Fed funds rate. I see Trump pressuring policy. I see AI replacing jobs quietly but quickly. And I also see some uncertainty building under the surface in terms of the stock market. So in my opinion, this is not a everything is fine moment right now. This is really a calm before the shift, in my opinion. And honestly, I don't think a lot of people are ready for what's about to happen. So let me land this plane for you real quick. You have an advantage, okay? You're not just listening to the headlines. You're thinking, you're watching videos like this on YouTube or listening to podcasts where you're thinking a little bit deeper and you're reading the real signals that are happening in our economy. You're watching the Fed and what they do. You're tracking the job cuts and you're paying attention to the missing data and you're preparing instead of reacting. That's why you have an advantage when you watch and listen to these type of channels on YouTube or podcasts. Now, unfortunately, most people won't notice this stuff until their job is on the line. You're already seeing this stuff early. That's why I'm here to recap this thing on a weekly basis for you on Sundays and put these things in plain language so they're easy to understand. Now, look, if you want to stay ready and build wealth while the economy is shifting, do me a favor and visit smartmoneybro.com. Everything you need to level up your personal finances is over there. Guys, listen, if you got value out of this video, do me a favor and smash that like button below for me. Drop a comment and let me know if you got value. And let me know if you see the job crisis coming in the same way that I do. Also, stay plugged in right here on this channel for more weekly updates. Look, guys, the best person who's going to take care of the old you is the young you. Until the next video, peace.